FY26 earnings conference call of Gulshan Polyols Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Charvin Zaveri from Share India Securities. Thank you, and over to you, sir.
Thank you and good evening, everyone. On behalf of Share India Securities, I welcome you all to Q4FY26 earnings conference call of Gulshan Polyols. We are pleased to have with us the management team represented by Ms. Aditi Pasari, Joint Managing Director, and Mr. Rajiv Gupta, CFO. We will have the opening remarks from the management followed by the question and answer session. Thank you, and over to you, ma'am.
Yeah, hello everyone. Good afternoon. And thank you for joining us today. With me is our CFO, Mr. Rajiv Gupta, and Ms. Ritika, our CS, along with Mr. Ripple Shah from NeoAtlas Capital, who is our investor relations consultant. I trust you have had the opportunity to review our financial results and investor presentation. FY26 has been an important year for Gulshan Polyols. This is the year where the investments we made in ethanol have started receiving meaningfully in our financial performance, improving both our revenue mix as well as overall margin profile. Over the years, we have steadily evolved from a single product PCC business into a diversified player across biofuels and specialty chemicals. Today, that transition is becoming visible not just operationally but also in the quality and visibility of our earnings. Our ethanol business is now the primary driver of the company, contributing over 60% of both revenue and profitability. We have an installed capacity of around 810 KLPD, placing us amongst the larger grain-based ethanol players in the country. One of the key strengths of this segment is its strong revenue visibility. We currently have an order book of about 18 crore litre, providing healthy near to medium term visibility alongside long-term offtake agreement for approximately 13 crore litre annually with OMCs extending through 2032. In addition, our classification as a dedicated ethanol player allows us priority allocation, further strengthening our ability to operate at stable utilization levels in a policy-driven environment. From a cost perspective, the availability of FCI rice has been a key positive this year. We are currently sourcing about 40% of our feedstock through FCI at fixed prices, which has significantly reduced volatility in input cost. At the same time, improved grain availability has softened maize prices, which are now in the range of rupees 19 to rupees 20 per kg, depending upon the region and the season. This has supported margins across the business. We continue to follow a lean inventory strategy of around 20 days, which allows us to remain cost efficient while ensuring operational continuity. Our byproduct, DDGS, continues to be an important contributor to the overall profitability of the ethanol segment. Realizations have improved from previous year, now ranging between 21 to 22 for maize and about 25 to 27 for rice, translating into an incremental 9 to 10 rupees per litre in ethanol economics. While this remains a strong supporting factor, we remain mindful that this is a commodity-linked product and can see some variability over time. Coming to our grain processing business, which includes sorbitol, starch, and fructose, this segment is gradually moving out of the down cycle we experienced last few years. Elevated maize prices had impacted export competitiveness and led to margin pressure. With the input costs now correcting, export opportunities have started to improve and we are seeing early signs of normalization. We are currently exporting sorbitol to over 45 countries and we continue to focus on improving cost efficiencies within this segment. One of the key initiatives has been to shift to an RDF-based fuel boiler at our Muzaffarnagar plant, which is structurally lowering our energy cost. Our mineral chemicals business has continued to perform steadily, supported by stable demand and long-standing customer relationship. This segment remains important to us from a cash flow and margin stability perspective. As we move into FY27, our focus is clearly on consolidation and improving efficiency across the business. Having completed a large part of our CapEx cycle, we are now shifting towards optimizing utilization and strengthening our balance sheet. We are targeting utilization levels of 80 to 90% across our key divisions, which should support revenue growth towards the range of 2,600 to 2,800 crores in this financial year. At the same time, we are focused on reducing working capital intensity and improving cash generation. Looking slightly ahead, from FY28 onwards, we intend to re-enter a growth phase with a focus on specialty and import substitute chemicals, which will help us move further up the value chain and reduce exposure to commodity cycles. Overall, we believe the business is now transitioning into a more stable and cash-generative phase with improved visibility on earnings and a stronger operating foundation. With that, I will now request Mr. Rajiv Gupta to take you through the financial performance in detail.
Yeah, thank you, Aditi, for giving me this opportunity. Now, let me share with the listeners our performance, and I will take through the profit P&L as well as the balance sheet developments, segment trends as well. Starting with the consolidated performance for Q4 FY26, our revenue for quarter stood at 550 crore, which is up by 7%. Primarily, the main contributor to the revenue growth is basically the ethanol segment. Though there was a subdued performance from the grain processing business, and while major chemical segment remains stable. Our revenue for FY26 was 2,314 crore, which is up by 14%. Now comes to EBITDA. EBITDA for the quarter was 65 crore, reflecting a growth of 121% year-on-year basis. It is improvement was largely led by better operating leverage in ethanol segment, supported by high utilization level and softer input cost. EBITDA for full financial year is 232 crore, which is up by 131%, which is excellent performance, which showed excellent performance by the company. EBITDA margin expanded by 612 basis points year-on-year basis to 11.9% in Q4. This is an important development for us as it reflects structurally stronger earning base as our DO capacity is stabilized. EBITDA margin for FY26 was 10% up by 504 basis points. Profit after tax also has improved upon, and it stood at 38 crore, up by 435% year-on-year basis, driven by improved operating performance and margin expansion. Tax for full year is 107 crore, which is 334% up from the last year. Ethanol segment, now moving to segmental performance. The ethanol segment reported revenue of 1,609 crore during the year, with EBITDA of 201 crore and margin of 12.5%. The performance was given by higher value, improved capacity utilization, and favorable feedstock mix. The segment continues to be primary earning driver for the company. The grain processing segment reported revenue of 610 crore with EBITDA of 13 crore and margin of 2.1%. Margin remains subdued due to pricing dynamics. However, with input cost now moderating, we expect gradual improvement going forward. The middle chemical segment reported revenue of 93 crore with an EBITDA of 23 crore and margin of 24.2%. The segment continues to deliver stable performance with healthy margin, acting as a consistent cash flow contributor. Now moving to the balance sheet side, our total debt currently stands at around 313 crore. That includes our long-term as well as working capital loan together. Our long-term debt remains highly cost-effective, with effective interest rate below 5% because of ISES, which is Interest Subvention Scheme. This provides us with a structural advantage in terms of cost of capital. Working capital borrowing are currently at an interest cost of 7.25%. Owing to prudent financial management, the dependence of working capital financing has reduced significantly and is expected to remain low through financial year 27 as well. Overall, the financial performance for the quarter reflects improving operating leverage, better cost structure, and a shift towards a more stable earning profile. With a sharper focus on utilizing working capital efficiency and cost discipline in financial year 27, we expect to deliver more consistent and predictable performance. With that, we would be happy to take over your questions. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Charchit Malu from Genuity Capital. Please go ahead.
Hi, sir. I'm audible. Hello.
Yes, you're audible.
Hi, thanks a lot for the opportunity. So my first question is regarding the order book. So, as of now, what are the current order book status and what is the implement duration going forward?
So for the ethanol segment, we in the FY25-26, which starts from November to October, we had an order book of about 18 crore liter, which computes about 1,250 crores in revenue. So that is the current order book status in the ethanol segment. We are, however, looking at increasing this allocation in the subsequent tenders, which are due to be released in the month of June. And as the next tenders, the C2 and C3 tender cycles come in, we are confident that we will be able to increase this order book from 18 crore liter to at least 22 crore liter in this very financial year.
Understood. My second question is regarding the E20 blending. So since we all know that government is planning for the E20 blending, right? So how much we are prepared for that, and what kind of margin bump or differences we can have from this revenue from that?
For E30 blending?
Yeah.
Yeah. So as far as Gulshan Polyols is concerned, we have capacity to produce 26 crore liter per annum. So we definitely have unused capacities currently from 18 to 26. So yes, we are very much prepared to increase to go up to 100% of capacity utilization as the government gives out the mandate for E30.
Do we have any official thing from the government side as well?
Yes, officially there has been statements that government is thinking of rolling out E30, E25, E27, E30. So there will be 3 to 4 kind of blends which will be available in the market. And we are looking at increased blending very soon, and we're looking at the government coming out with a new tender maybe in the very near future.
And what kind of margin difference we can expect?
So based on current pricing, I'm quite confident that government will continue to give us FCI rights at least for the next 2 to 3 years, because we are aware that the government, there's a lot of background noise on this call, so I'm unable to actually hear the speaker. Okay. So based on the fact that FCI is sitting on more than 400 million tons of rice, we are very confident that the FCI rice will be made available to the ethanol industry for at least next 2 to 3 years. And until that is available, the balanced raw material, which is maize and broken rice, will definitely be more fluid and availability will improve and the prices will remain softened. So until this scenario is on, we can expect to continue with the kind of results that we have given out in this quarter. We are very confident that we will be able to give out such results quarter on quarter.
Great. And just last question, what kind of revenue and EBITDA we are targeting for F27 and F28?
For FY27, we are definitely looking at about 2,600 to 2,800 crore of EBITDA, which I'm expecting that about 1,800 to 1,900 should come from the ethanol segment.
Okay.
Based on further allocations. About 800 we are targeting to get from the grain segment and about 100 from the mineral segment. So all put together, we should be looking at achieving this figure in FY27. And if I talk about the EBITDA margins, definitely looking at about 10 to 12% EBITDA margins in this financial year.
Understood. Great. And at the PAT level?
About 5 to 6.
Understood. Okay. Thanks a lot.
Thank you. The next question is from the line of Sanjay Manial from DAM Capital. Please go ahead.
Hello, ma'am. Just want to understand what is our ethanol volume for Q4? My calculation says it should be somewhere around 4.5 crore liters, and which seems to be a decline from previous year as well as previous quarter. So what could be the reason for that?
You see, the previous year we had a total allocation of about 21 crore liter, and this year it is 18 crore liter. And also we are expecting further allocations in the balance 2 quarters of the ESY 25-26. So because the government has already given out the mandate for increasing blending, so therefore they will be looking out at giving out further tenders and further allocation will be received by the company in the next 6 months, in the next 2 ESY quarters, and we will be able to make up this revenue which we lost in quarter 4.
Okay, so 18 crore liters is something allocation which you got from say November to October, and
correct.
What out of that, how much you have already fulfilled till March?
About 50%.
Okay, so 9 crore volume we can expect over the next 2 quarters broadly.
Yes.
Until unless and if we get additional orders, then probably that will add to the volumes only.
Yes, we will get additional orders. We are very confident because government is increasing blending. It will have to really come out with new tenders.
Right. And EBITDA per liter, if I just calculate, it should be somewhere around 13 rupees a liter, if I'm not wrong.
Yes, we can say it. No, not 30. At EBITDA level, I would say, if I'm saying 12%, so that's about 10 to 11 rupees average.
Okay.
Yeah.
And does our result in the quarter include any subsidy amount?
In quarter 4, we have not received any subsidy.
Okay, and
it's only the operational profits.
Okay, and are we expecting any kind of subsidy over the next few quarters?
In quarter 1, we are expecting an additional 5 crores capital subsidy underneath policy for our SAM plant. And the PLI should come by the end of the year.
And what would be that amount?
The total PLI due between Assam and MP is about 30 crores per annum.
Okay. Right. Thank you for that. And just sort of last one from the grain processing segment. I believe this was one of the segment where you were struggling from last few years with the low margin.
Yes.
In the current quarter, it seems to be a profitable segment. What is the outlook on this in FY27? Means given the fact that some bit of profitability is now achieved in the current quarter, what kind of margins are we expecting in this business, and what kind of a growth we are expecting in this business?
So definitely, I feel the worst is over for the grain processing division, and already the signs of improvement have started showing up in this quarter. And going forward, I'm expecting further improvement on the sorbitol, fructose, and starch front. So in FY27, I definitely have a target of being able to achieve about 5% EBITDA on this segment, so which will amount to about 40 crores at the EBITDA levels on a revenue of 800 crores.
Okay. And just maybe last one, if I can ask. So what we understand that you're almost very close to the full utilization of all your segments. At least ethanol is 80% plus, and even the other segments. How should we build in the growth over the next, say, 2, 3, 4 years period? Given the fact that your utilizations are already full, means what kind of a capex or any diversification which we'll probably taking over the next 4, 5 years?
Yes, so capex will start coming in FY28. We are already evaluating new products, mostly in the specialty chemical space, which will be maybe a little bit of capacity enhancements of our existing products, maybe sorbitol and fructose. And secondly, we're also looking at introducing new products which are import substitutes, but in the grain processing division. So the fresh capex will come in FY28. Until then, we are looking at improving the cash flows in the next 4 to 5 quarters.
Okay.
So in the current revenue, with the current setup, we are very confident that we can easily achieve, depending on the market condition and the order book, a revenue of about 2,800 crores is very much achievable with the current setup. Even up to 3,000 crores can be achieved with the current setup on 100% utilization. And beyond that, yes, fresh capex is required, which we have already started planning. We have already bought a piece of land in Madhya Pradesh, in Narsingpur, about 100 acres. So we are looking at setting up, and we are evaluating a mega project for that land, for which the capex will start in FY28. Until then, we are actually going through various proposals and evaluating various products.
Okay, perfect. Thank you very much for all this.
Thank you. The next question is from the line of Mukesh Panjwani from WC Securities. Please go ahead.
Yeah. Hi, am I audible?
Yes.
Yeah. Congratulations on great set of numbers.
Thank you.
In your presentation, you have mentioned like from FY28 onwards, we intend to re-enter the growth phase with a focus on specialty and import substitute chemicals. So can you throw some light on this?
Yes, as I just answered, so we are looking at doing some fresh capex in the specialty chemical space. It will be mostly import substitutes, introducing new products, something which is not being produced in the country. We have bought a piece of land, about 100 acres in Narsingpur in Madhya Pradesh. We are looking at a mega project in that area, maybe looking at a capex of about 500 crores going forward. Which will mostly be in the grain processing segment in the specialty chemical division. So we are in the process of evaluating different projects as we speak.
Okay. Thank you. That's all from my side, and all the best.
Thank you. The next question is from the line of Pushpar Jain from Milli Capital. Please go ahead.
Hello, am I audible?
Yes.
Yeah, ma'am. So given like the recent softness in maize mandi prices, is there a risk that farmers may reduce their sowing acreage next season, or what is your outlook in general about the maize prices also because of the unusual rains in the north? Is there any impact on the quality that we are getting?
An agri business, we are very used to these things. Like we have been actually procuring maize from the past 25 years. We have always been a grain processing company. First we were making sorbitol, then starch, then fructose, now ethanol. So grain is not new to us. The fluctuations in grain prices is not new to us. And any kind of rains hampering the crop is not new to us. But now those things are actually quite old. The farming techniques have very much evolved, and crops are not getting affected as the way they used to be. And even the logistics has improved so much that today, the maize is being produced in different months in different parts of the country. It is not that only Bihar is producing maize. Now even Assam is producing maize, even UP is producing maize in this season. So we are getting from many, many regions. So now the effect is not as much because of climate conditions. And as far as the farmers are concerned, they are very happy with the prices that they are getting and that the revenues they are receiving and the cash flow for them has improved. Ethanol industry and the starch industry is paying the farmers within 10 to 15 days, which is fantastic circulation of the money of the crop. And a maize crop is grown within 90 days, so they can actually use the same land with about 3 to 4 rotation of crops. So farmers are very happy, and going forward, the yield per hectare will only improve for maize.
Right. So any outlook on the prices for maize in next, say, 1-2 quarters?
Currently the prices are ranging between 19 to 22 rupees depending on the region. Like right now it is in the north we have the Rabi crop, so we are getting better favorable prices in the northern plants, crops from Bihar and UP and Assam. So there in that region we are getting at about 19-20 rupees. MP we are getting about 22 rupees. But now in the second half of the year, when the Kharif crop comes in, this will reverse. MP will receive better price crop at about 18-19 rupees, and Assam and Muzaffarnagar will receive at about 22 rupees. So this will keep changing, depends on the geography. But the range is this, which I think will continue for the whole year.
Right. And our break-even cost would be like something, right?
Sorry, I lost you. Will be what?
Like our break-even cost for ethanol would be maize at 27-28, right?
No. At EBITDA level, 24. Positive EBITDA at 24 rupees.
Okay. Thanks a lot, ma'am.
Yeah.
Thank you. The next question is from the line of Nirav Bhanushali from Systematics PMS and AIF. Please go ahead.
Hello, am I audible?
Yes.
Yes, thanks for the opportunity and congrats on good set of numbers. My question was regarding the CapEx, which you were mentioning that you're planning to spend around 500 crores. So how is it? How should we? It should be distributed over 28, 29, and like the funding of that equity and debt ratio on that front.
It is going to be a combination of everything. We yet have to put those details together and get the board approval. So it will be spread over 28 and 29, over 2 to 3 years, because it is going to be a mega project. So yes, it is going to be a combination of debt, equity, both. And it required some fundraising, but we are evaluating all options.
And second is what kind of IRR we are seeing for this, which products we are planning or for this kind of big capex?
So any product which we are evaluating should have an EBITDA of about 15%. That is our basis of evaluating and finalizing the product. So yes, based on that, about we can expect ROCE about 22%.
Okay. Yeah.
But again, all depends. We are still in the process of finalizing the project.
My second question was on this, which is blending milestone. Like we have currently the government has close to E20, and there were talks that this E23 or 27 will be on the fast track. So you can give some update on that side.
Yes, ethanol is a very, very favorable policy for the government and for the country in every way. And with the crude prices going on all-time high, it is only favorable for the government to increase the blending as far as possible. And the country has already shown that how easily it has achieved E20, and the ethanol industry is sitting on free unutilized capacities. So it is very favorable for the government to shift to increase blending 22, 25, 30, also E100, E85. So there are various models which the government is evaluating and rolling out very, very soon. In fact, already this year there is going to be a trial of E100 in about 100 petrol pumps all over the country. And next year this will go up to about 5,000 petrol pumps all over the country. Government is very, very in favor of increasing blending, and as a country we are actually very proud that we have been able to compete with the ethanol players of the world, which is USA and Brazil, in being able to blend ethanol at such high levels in such a short time.
Okay. Thanks for answering my question, and best of luck for future.
Thank you.
The next question is from the line of Charvin Zaveri from Share India. Please go ahead.
Oh, yes. Thank you for the opportunity. So my question was, among the company's three major segments, which are the ethanol, grain processing, and mineral processing, which segment do you think which will be contributing the highest incremental EBITDA growth over the next 2-3 years?
Of course, for next 2 years, this year, the ethanol segment has been the major revenue contributor as well as the profitability contributor, and I expect the same trend to continue over next 2 to 3 years. And any kind of this mix will change once we are coming out with our new capex and we are into the next growth phase. But until then, I'm expecting ethanol segment to be leading the revenue as well as the profitability for next 2 to 3 years.
Okay, and also could you elaborate more on the specialty chemicals opportunities that you said that you'll be evaluating after the FY28? So, like how much margin will it be contributing, and how much growth will it be contributing going forward?
We are looking at coming out with a mega project. Looking at a project of about the capex of about 500 crores. So which should be able to give us generate a revenue of about 1,000 to 1,500 crores. So our vision for the next 4 years is to take the company to about revenue of about 5,000 crores. So that is the target, the vision for the company.
Okay, thank you so much.
Thank you. The next question is from the line of Het Korecha from Ventura Investments. Please go ahead.
Hi, am I audible?
Yes, you are audible.
Good evening, and thank you for the opportunity. So congratulations to the management on delivering a strong set of numbers. So
thank you.
My question is regarding the raw material side. Could you share the current raw material mix for the business, and specifically how the release of FCI rice has impacted the cost and overall procurement economics in different quarters?
So government has made a mandate for ethanol industry to lift 40% FCI rice to produce ethanol. That has increased the grain availability, the balanced grain availability in the country, and also softened the maize and damaged broken rice prices. So this year, especially in the last Q3, Q4, after the mandate got executed, we saw a sharp drop in maize and rice prices, which also directly impacted the profitability of the company. And as we can see in last 2 quarters, operational profits in the ethanol segment have sharply risen, and I'm expecting a similar pattern to follow in the next 2 years until the FCI rice will be made available to the ethanol industry.
Okay, thank you.
Thank you. The next question is from the line of Ayushman Thakkar from 18U Advisory LLP. Please go ahead.
Hello, am I audible?
Yes.
Good evening, everyone. And first of all, congratulations to the management on delivering such a strong set of numbers. I had a question regarding the working capital. Could you please help us understand the reason behind the inventory buildup witnessed in Q4? And following up to that, whether this is a temporary phenomenon or something more structural in nature?
So this is a pattern you will actually see every year, that there is inventory build-up in quarter 4. That is because the OMCs tend to increase their listings from the sugar industry as compared to the grain division, because ethanol from sugar is available only till March and maximum April. After this, they are fully dependent on the grain ethanol manufacturers. So this is a typical scene which we are seeing since last 2 years, that in March end we tend to sit on some ethanol inventories. The lifting is comparatively slower, but however, in the subsequent quarter, this has always got evened out.
Understood. And I had one question regarding the order book. Like, was the order book allocation has been in line with your expectations?
Current order book is definitely lower than what we had applied for and expected. Last year we had an order book of 21 crore liter, and this year we wanted to get allocations for 23 crore liter, against which we received for 18 crore liter. However, we are very confident that in the next 2 quarters of this ethanol year, we will be able to make up this gap, because the government is very robust and very positive in increasing the blending, and as it will increase its blending, its requirement for ethanol will increase, and they will have to come out with further more tenders, and based on which we will be able to increase our allocation.
All right. Understood. Thank you so much, and all the very best for the future.
Thank you.
Thank you. Participants who wish to ask questions may press star and 1 at this time. The next question is from the line of Kavya Padia from Analyum Capital. Please go ahead.
Hello, am I audible?
Yes.
So my question is, how exposed is the company to the export market volatility, and particularly from China?
I'm not able to understand. Can you please repeat your question?
My question is, how exposed is the company to the export market volatility, and that particularly from China?
So, company exports sorbitol to about 45 countries. Right now, in fact, the exports of sorbitol and starch in the country have improved, as it is now able to compete with China and other countries, because there is softening of maize prices across the country. So now it is more price competitive. So hence the exports for starch and starch derivatives has increased, and even the company is able to get better realization and better margins on these products.
Okay, thank you.
Thank you. The next question is from the line of Sachin, an individual investor. Please go ahead. Mr. Sachin, your line has been unmuted. Please go ahead with your question.
Hello. Am I audible? Hello.
Yes, you're audible.
Yeah, congratulations on the good set of number. I have a question regarding ethanol segment, like as you said.
Sorry to interrupt. Mr. Sachin, may we request you move a bit closer to the microphone?
Hello. Now is it audible correctly? Hello.
Yes, it's better.
Yeah, so actually I was asking regarding ethanol segment, and just now you said government is actively planning for increasing to E30 and even looking for E85, E100, E100 also. So after looking at that, we can see that at present, yes, we have that over capacity of ethanol production, but with the increase in government blending, so do we see any kind of like oversupply or over demand coming in this segment in coming years?
See, the demand will be met with supply. That is for sure. I mean, ethanol industry has been supporting the government's demand over last 3 years, and Government wants 20, ethanol industry is ready with 25. So I don't ever see that demand will be more than supply. That problem of the government is over. Ethanol industry has come out in a very strong way and is able to produce more than 2,000 crore liters with existing capacities and the capacities which are already in the pipeline. Hence, I don't see any government having any issue with getting supplies of ethanol in the next few years.
Okay. So are we looking at any kind of CapEx in ethanol segment also?
We are not close to it, but yes, with time we may look at enhancing some capacities if required.
Okay. Thank you so much. Thank you.
Thank you. The next question is from the line of Kinjal Jain from InvestNova Advisory. Please go ahead.
Hello, am I audible?
Yes.
Hello.
Yes, you're audible.
Yeah. So thank you for the opportunity to ask this question. So I have two questions. So first one is, a significant part of the recent improvement in profitability should be driven by favorable dynamics in the ethanol segment, right? So could you help us understand how sustainable the current level of profitability and EBITDA margins in the ethanol business are over the medium term, especially as blending levels mature and industry supply increases?
We are very confident that we will be able to sustain these margins over next 2 to 3 years and able to give out these EBITDA levels quarter on quarter. As we are basically very confident that the government will continue supplying FCI rice to the ethanol industry, and until that is happening, the entire grain agronomy will stay in balance, and the prices of maize and broken rice will also remain softened. So until that is happening, we are very confident that we will be able to sustain these margins over next 2 years.
Okay, and my second question is, given the increasing uncertainty in export markets and continued competitive pressures like from Chinese players across several segments, could you help us understand how exposed the company is to export market volatility and what measures are being taken to maintain competitiveness and protect margins going forward?
Actually, our export is actually quite small as compared to the entire revenue basket. We are only exporting about softball of 100 crores to various countries, which is a very, very small share. So we are not very, very affected by Chinese prices and volatility in a very big way. We are not very exposed to it. Most of our supplies are domestic. 80 to 90% supplies are domestic. So we don't remain very exposed to export pressures.
Okay, got it. Thank you.
Thank you. The next question is from the line of Nigesh Motamari from an individual investor. Please go ahead.
Good evening, madam, and congratulations for the good set of numbers.
Thank you.
Just wanted to know what is the increase in the non-current investments in this financial year, ma'am? From 16 crores, it has been increased to 47 crores. Is it elsewhere or?
Which figure are you seeing?
Non-current investments. Last year it was 16 crores. And
these are the mutual funds? Are these?
Yeah.
So we have actually invested some money in mutual funds.
Okay.
So this is basically we are maintaining a positive working cycle because we have some commitments with the bank where we have to have some minimum utilization levels of working capital. Hence, we have actually utilized some funds, invested some funds in mutual funds.
Okay. And can I know when you expect to become a debt-free company, ma'am, going with the rate of income and other things? Any idea?
Oh, well, next 2 years, definitely we could be a debt-free company by FY29. I'm confident of that. But but our long-term debt will continue till 30. We have our repayments are due for Assam plant, which will continue until FY32 actually. It's a 8-year plan. So yes, so that will remain. Apart from that, I'm quite confident next 2 years we will be debt-free, bearing apart from the long-term loan on Assam plant.
Okay. And how long will be the PLI incentives coming to us?
For MP, we will get for 7 years. Assam, we will get for 3 years.
Okay. Because this 4.6% PAT margin includes PLI which we got, right?
Yes, yes.
Okay. Okay, ma'am. Thank you. That's it from my. All the best.
Thank you. Participants who wish to ask questions may press star and 1 at this time. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
I would like to thank everyone for joining this call and asking very valuable questions. Interaction with investors always improves our own learning of the business and also the sentiments. I'm very grateful to Atlas for having and Share Capital for organizing this call for us. And feel free to reach out to our company secretary as well as Rutal, who is our investor relations consultant, for any further clarifications. And all I wish to say that yes, company is on a U-turn recovery mode, and we are very confident that we will be able to give out good set of numbers quarter on quarter and create value for the company and for the shareholders. Thank you. Thank you very much.
Thank you. On behalf of Gulshan Polyols Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.